Good afternoon, everyone, and thank you for joining us for a timely capital markets update. I'm Barry Mandenack, Executive Vice President and Head of Distribution at Virtus Investment Partners. I'm fortunate to be joined today by Virtus Senior Managing Director and Chief Market Strategist, Joe Terranova. Joe's going to spend a few minutes sharing his insights on recent market events before getting right to the discussion of our featured panelists. For today's discussion, I'm pleased to welcome thought leaders from four of our investment managers at Virtus. First, Dave Albright, President and Chief Investment Officer at New Fleet Asset Management. Roy Barron, Co-President and Co-Chief Investment Officer at Westchester Capital Management. John Christensen, a Portfolio Manager and Senior Research Analyst at Kayne Anderson Rudnick Investment Management. And lastly, Mike Sensoterra, Chief Investment Officer and Senior Portfolio Manager at Sylvant Capital Management. Welcome and thanks all for joining us. Before I turn the discussion over to Joe, I'd like to remind our audience members that we invite them to ask questions at any time throughout the webinar. To ask a question, please type it into the Q&A section at the bottom of the screen. And with that, I'll turn it over to Joe.
Thank you, Barry. Appreciate the wonderful introduction. Good afternoon to all of you that have taken time out of your busy schedule to join us today. We all very much appreciate you doing so. And welcome to 2026. Here we are, a new year in which I believe you, as stewards of capital, are blessed with the opportunity of a much healthier marketplace, a marketplace that through the course of 2025 really began to reshape itself away from the 2023 and 2024 market, where we had a very narrow, concentrated set of assets in which the performance was being delivered. Now, where we are today, it's about a conversation about really thinking how we can find opportunities in each and every asset class. That's a type of environment that we have not been in many, many years. And it's great with that environment in mind to have with us today John, Roy, Michael, and David. Now, we might ultimately in 2026 have to pay a little bit of a price. The market always makes you pay a price for something really good. And for that healthier environment, I would expect that we are going to have a little bit of elevated volatility. I'm going to abbreviate my remarks to cede my time to the panelists and the questions that we're going to ask them today. I want to share with all of you that we are going to engage in dialogue with all of you. I have a chat function that is open here for this webinar. Please type your question in there. I will read your question and I will direct the question to the panelists that I believe can best answer that. If you are seeking information beyond what you hear today, in particular from myself or other panelists, at the end of the year on Virtus Investment Partners website, we cataloged a series of videos that shared the observation of 2025 for portfolio managers, myself included, and what the expectations are for 2026. I think you might enjoy it. I encourage all of you to go to the Virtus website, click on our leadership, Thought Leadership, Our Thinking tab is where you'll find it, and you'll find some really informative videos. I encourage all of you to do that. So with that being said, David Albright, let me first turn to you. Great to see you.
Thanks, Joe.
And Dave, beginning in September of 2024, the Federal Reserve began a process of lowering interest rates. 6 rate cuts, as I have it calculated now, through the last one on December 10th. We had 100 basis points worth of cuts in 2024. And here in 2025, or rather, last year in 2025, we had 75 basis points rates of cuts. So 175 basis points of rate cuts in totality. Global central banks, they're coordinated in that easier monetary policy. Global central banks, their last policy action being a rate cut, I think that's currently stands at about 86%. And we heard the president this afternoon speaking on CNBC with Joe Kernan, basically saying he has his Federal Reserve candidate down to 1, maybe 2, or possibly 3 candidates. So share with all of us how you're thinking about Fed policy interest rates. And I have to ask you, does it make much of a difference to you as a manager of fixed income assets who ultimately is chosen as Federal Reserve Chairman from the candidates that we've identified?
Good question. I would just start with Joe. We're constructive on fixed income. As you had mentioned, we have an accommodative Fed. They've been cutting rates. The economy's good. Earnings are good. Leverage is low if you look at it versus long-term averages. Positive flows, which resulted in strong fixed income returns in 2025. Fed fund futures calling for 2 more rate cuts. It's still in the cards right now for probably sometime later in the year. And we're in an environment where you're set up for what I would call coupon plus type returns for 2026. Things you need to watch: tariffs, tight spreads in fixed income. We still have geopolitical uncertainty. Inflation elevated. It's been 4 years since we got to the Fed's target. And Fed policy uncertainty are sort of what we're looking for. Really, who becomes the next Fed chairman? If you go back to the Lyndon Baines Johnson administration, that's the last time that a sitting president did not put in the majority. So we think it will still be a fair Fed, regardless of who's picked. Obviously, the 2 picks that it comes down to right now, we know that Hassett maybe is out, but Warsh and Weller probably are the 2 most likely. And then we could also look at Rick Rieder being there, but it's indifferent to us.
Well, Dave, you could tell from my youthful hair that I don't remember the LBJ administration. Thank you for reminding all of us of that Federal Reserve history. Certainly, Roy, by the way, great to see you. It is a different environment, and in particular, for the world that you're managing assets in. I think the regulatory relief is one of the stealth indicators in 2025 and really one of the stealth tailwinds. It was remarkable to me, and correct me if you would on this. I think US M&A came in somewhere about up 60+% on a year-on-year basis, but you actually had deals in the financial services industry, the Comerica Fifth Third $10.9 billion deal, Cadence, Huntington Bank, and Synovus and Pinnacle. So when you see that paradigm shift that clearly unfolded in 2025, attributable to the Trump administration, first of all, kind of compare the environment to prior administrations, and then share with us your confidence that it's going to be sustainable here over the coming years, which creates a really fertile environment for your asset class.
Hi, Joe. Thank you for having me. You took many of the words out of my mouth already, and although I wouldn't say it was so much of a stealth tailwind, the regulatory change has been very, very pronounced. The effect of regulators on deal announcements is quite significant, because when a company announces a transaction, they have to hire bankers, they have to borrow money, they have to hire lawyers, and it's a very distracting event for a company to make a large acquisition. We saw a huge comeback as soon as Trump came back to office. There was a little bit of a delay because they had to hire company, they had to hire lawyers, they had to hire bankers, they had to reset their whole strategic compass. But we saw deal activity significantly pick up. If you look at 2023, 24, 25, 2025 was the second largest deal environment by total volume on record. And in addition, we saw a huge pickup in private equity transactions as well. Deal size was affected. We had very large transactions, and also the length of time that it took for deals to close was compressed compared to the Biden administration. The regulators under Trump are very, very business friendly, and they kind of understand the synergies and the effects, the positive effects for hiring and for business in general that can come from the efficiencies that are achieved through mergers. In addition to that, rates have come down, making it a little bit easier to finance transactions. Stock market has gone up, making it easier to pay for a deal with stock as currency. You have more valuable currency, and so both of those were kind of tinder for the fire, if you will, that caused the huge pickup in deal activity. Many large deals. We had some what we call mega deals over $10 billion that were a record. The Warner Brothers deal alone, which I guess we'll get to later, is over $100 billion. There's the largest private equity deal, the largest leverage buyout on record was the Electronic Arts acquisition by Silver Lake, which is still pending. And I could go on, but suffice it to say that the environment has gotten a lot better.
Let me just ask you a follow-up. I mentioned in kind of leading this conversation that I do think 2026 greets investors with higher volatility. I don't think you can expect the very calm volatility environment that we've had in the last 2 years, in particular in the bond market. Bond market volatility was historically low last year. So how do you think about the environment acting in continuance if we get that kind of uptick in volatility?
Well, for M&A activity itself, it shouldn't be affected by the increase in volatility. The transactions tend to be much more strategic in nature. Even LBOs, I mean, they project out many, many years. Transactions are very, very well thought of. But for us in particular, the volatility adds to the opportunity set. There are times when, when a stock trades down or the market trades down and spreads widen out that make for better opportunities for us to invest in. And also, as something that we can get to as the webinar goes on, merger arbitrage tends to be uncorrelated with the stock market in general. So it's much more of an absolute return type of strategy, a sleep well at night strategy, if you will.
Okay, and then just the other side of that, if you would, 2026 potentially is a year where a lot of these private equity giants sitting on the sidelines, maybe they kind of slowly walk to the public market. Maybe it's SpaceX, maybe it's Databricks, maybe it's Anthropic, maybe at some point, ultimately it's OpenAI. How are you thinking about that as well?
So, the capital markets have opened up. There's a lot of demand for these mega cap private companies such as the SpaceX and whatnot, but also it will lead to transactions. I mean, we don't take advantage of private companies that are being bought, but to the extent that private equity firms acquire publicly traded companies to tuck in with their private firms, we're happy to take advantage of that and invest in those. So far, the environment has continued on from the fourth quarter of 2025 to the first quarter of 2026. And again, with the cost of capital coming down, it makes it a lot easier for strategic buyers as well as financial buyers to step up. And that includes financing coming from private credit as well, which, as we know, is a big trend.
Thank you for that. John Christensen, good afternoon. Congratulations on your Rams advancing to the NFC Championship.
Thanks, Joe. Good to see you.
Good to see you as well. So, I mentioned to Dave, the Federal Reserve began in September of 2024 lowering interest rates. And that really was the moment where the momentum factor began to significantly outperform the quality factor. As you move towards the end of 2025, and this is where I kind of get the confidence that, in fact, you do have opportunity in places that were unappealing the last several years. The quality factor began to outperform. Small caps and mid caps began to outperform. So if I look back in the entirety of 2025 and really going back to the 24, you're going to see a large divergence as it relates to small and mid caps. How do you think about collectively all of that as you move into the new calendar year? Momentum with the meaningful outperformance to quality, the divergence in style between small and mid cap.
Yeah, no, those are important points, absolutely. And Joe, you pointed out, to think about the story here in 2025, you go back to 2024 as well, right? There was another year where high quality lagged and low quality was still in favor substantially, especially with the large caps. But 2025 was very different in that if you think about the first part of the year, right, when it was interesting how DeepSeek came out, it felt like the AI trade was starting to get a little bit long in the tooth, and you saw some weakness in the market. Us as high quality investors had significant outperformance on a relative basis. But then obviously tariffs were announced, Liberation Day came on April 2nd. And that's when, as you pointed out, you started seeing some pretty significant increases in that momentum trade, in the lower quality trade. And this chart here really points that out very amazingly in the sense of when you look at that divergence between the momentum and quality, it's some of the largest we've seen, in a very, very long time. not only quality, but also low volatility as well has also trailed a lot. So what we're seeing now is, what happens in the end is, valuations eventually matter. So as we've seen these trades come for lower quality, we notice now the valuations are getting pretty egregious. That's when the market starts seeing that transition. I think to your point, interest rates coming down does kind of help that small and mid cap stocks. Yes, it does help the more lower quality that have a lot more debt on the balance sheet first, but we think that the rising tide kind of helps the entire asset class. So when you see where we trade higher quality, which has not gotten the love, the valuations are much more attractive. And this is where we're starting to see a little bit of that, a little bit of a rotation into our types of companies. So this is kind of gives us confidence that as we move here into 2026, we will start seeing that rotation. Valuation matters. So we're kind of confident the more higher quality will start acting better, especially if the businesses hold up.
Michael Sansoterra, great to see you this afternoon. Listening to John's final sentence there, I guess the question would be, does the recovery, if you would, in high quality come at the expense of growth, and growth stocks in particular, which without question, they have been the anchor of the bull market since October of 2022. And they were the anchor of the bull market because of the innovation. And in addition to that, the spectacular earnings growth correlating with advancing that innovation. So here we are in 26, and it seems like it's kind of binary. I'm hearing a lot of that where it's no. We're at a point of maturity for the growth stocks, and now we kind of want to take a look into a different equity size class or different strategy. Why can't it be both? And where does that leave you thinking for growth stocks in 26?
Yeah, that's a great question, Joe. And thanks for it. Good to see you. It's definitely not binary. It's definitely both. It's never quite as clean as we'd like it to be. But we could see some profit taking after 3 solid years of some of the largest cap companies, particularly in technology, outgrowing and outperforming every other asset class. Now, like to your point, the reason they did that was not because we're just in love with them. It's because their revenue, earnings, and free cash flow were carrying much of the market's growth, and in fact, continue to do so. 22% growth expectations from those largest companies going into this next quarter versus 3 for the rest of the S&P 500. So it's still happening. The fundamentals are still there, but to the point made earlier, the spreading out that small cap, mid cap, not so much momentum, not so much large cap breadth is exceptionally encouraging for us. As what we want to see is companies growing. Regardless of what the growth is, the expectations of growth being met and then exceeded is what makes these stocks work of every type of growth, value, large, small. So we think large cap growth fundamentally is still in a very good position. We think these companies are still in early stages of this expansion. Capital expenditures, revenue, and earnings all point to a strong backdrop. But that doesn't mean small cap and mid cap can't do well at the same time. And for us, we think that's great. It's more healthy a market. It takes a little pressure off the stocks and the expectations. To your point earlier about volatility, it actually lowers some of the volatility when you have the rest of the market rising, as we've seen in the early days of January, pretty quickly. It says, okay, we are looking at other securities again. We recognize trees don't grow to the sky. But at the same time, this is a long tail. A lot of these mega cap stocks are in the artificial intelligence trade. It's a long-tailed event. You will not see it shut down quickly. We don't think 2026 is anywhere near that year. So the revenue, the earnings, the free cash flow will continue. And the fact that these small cap companies and now are, to quote earlier statement, getting some love, that's great. That's actually good. We think it's healthy. It doesn't bode poorly for growth. You could always see some consolidation, some folks taking some profit. If you really look at the Russell 1000 Growth Index, you see the last 3 months solid. It's really just trading in a range. And you kind of forget about that when you have good returns. But it's a big range, but it's still a range. And that's okay, right? Sometimes these companies have to grow into their multiples, have to take a breather before moving on, to higher levels. But you've still got companies in the space that are trading, below a market multiple, growing 2-3 times the market itself. That doesn't mean that they're not going to outperform. It just means that they're not even expensive anymore. So you've got opportunities, I think, on both sides. I think growth continues to look strong going into 2026.
Yeah, I like that. And the other element in the growth conversation, and I think it's a mistaken philosophy, is that growth is directly found in technology and comm services. I don't know. I could find growth in healthcare. I could find growth in materials. I could find growth in consumer discretionary. I could find growth in other sectors that maybe are just unfamiliar to investors over the last several years, can I?
Absolutely. Yeah, we couldn't agree more. A lot of managers get really wrapped up in tech, and it's easy to do so when north of 50% of the Russell 1000 growth index is technology. But you're right. There's, the 7 GIC sectors that make up 98% of the weight of the index all have growth in them. Growth's a condition, not a category, is what we say. And when you can find something like Eli Lilly with the GLP-1 base, when you can find Intuitive Surgical with the Da Vinci product line, you find lots of places in healthcare. You find lots of places in consumer discretionary, even in financials. There's all kinds of opportunities. The best portfolios, in our opinion, are built around multiple different types of growth, not just one theme or one exposure or one industry or sector, but there's lots and lots of places. Remember, it's a condition of change, and if you can find expectations being beat, the market is ripe with growth opportunities as far as we're concerned.
David Albright, this is always one of the more enjoyable questions that I get to ask you because it's very informative and it helps me personally. I know it helps everyone on the call. So I'll just ask you very succinctly and very specifically. Let's go. Where are the best opportunities as you see them right now in fixed income?
Sure, Joe. Well, I always look to my relative value has been restored. When I look at assets with discount dollar prices and all-in yield still being very attractive, that gets institutional accounts, pension funds, insurance companies happy about yields where they actually can pay their liabilities. That's really good, albeit it's much lower than last year. Fixed income really is still very attractive as an asset class. If I look over the next 12 months, no recession, solid fundamentals, very strong technicals, moderate growth, which is extremely supportive of this. But if I look at relative value, I would say asset-backed securities, those in the securitized industry look very, very attractive. They amortize. They're very short in duration. We're up in the stack, very good yields. The market's been on fire this year. Seen 17 deals come and spreads have gapped in very, very quickly. We're overweight asset backs and we like it. And it's performed extremely well. Not agency mortgage backs. I think we saw the Trump administration give the GSE the go-ahead on purchasing $200 billion of mortgages. We got our performance out of the agency mortgage space in the first 2 weeks of the year. However, the non-agency space is starting to now catch a bid, up in quality, top of the stack. Mortgage market's in very good shape. There's a shortage of housing, which continues. It was about 700,000 houses short per year, going all the way back to 2009. So still insatiable demand. My recommendation based on what Trump's doing is buy your house now, lock in a rate, and then refinance when rates go down, because the prices are definitely going up due to the shortage. But those are probably our 2 favorite sectors. And then one that I'd say that was a great performer last year, which continues, is in the high yield space, is emerging markets high yield.
And just as it relates to emerging market high yield, and in 25, obviously, that we saw the emergence of tailwinds. Do you believe those tailwinds have intensified because of what has unfolded as it relates to Venezuela?
I mean, Venezuela, that's up about 35-40% off a very, very low base. That was one of the catalysts for high yield.
Mm-hmm.
But it's very idiosyncratic and very country specific. We had some other things there where Ukraine also traded up, but it's something we watch very, very closely. Yields started the year probably in the mid 11s, ended the year at about 870. So a big jump in performance. They returned probably in the 20% range for high yield. That was a good catalyst. For the first time in Going back to 2017, you saw inflows into the space, 83 billion. You know, a lot of that wasn't to dedicated strategies, Joe. That was the guys like me, the multi-sector funds who allocated to that sector. So yeah, we like emerging markets. We think it's had a good run. Spreads have gotten a little more, little more testy. So I'd say maybe a little on the tighter side. Right now, we're looking at making some intra-sector moves within EM, looking to swap out of some of the sectors going to EM corporates, which now still look attractive. But you know that market's typically very front end loaded, so a lot of the issuance comes out early in the year, especially in the sovereign space.
And from my perspective, monetary policy and a lower U.S. dollar act as an ally for EM debt. Would you agree with that?
Without question, you know, especially when you look at a local currency. Local currency was up average about 20% last year. We're adding exposure there. You know, when we think that there's the potential for higher growth and improving fundamentals, so we like it, but absolutely, without a doubt, as the Fed's cutting rates here, gives them you know, an ability to really you know, expand their fiscal policy and also their interest rate policies.
All right, Roy, I get to ask someone else. I don't have to answer the questions as it relates to Netflix, Paramount, and Warner Brothers and this bidding war that's been going on. I don't get it from Netflix's perspective. That's just my personal opinion. You know, Curb Your Enthusiasm's not on HBO anymore, or The Sopranos aren't on, so I don't know that I need to see that on Netflix. But they suspended buybacks. They're going to spend 10% more next year on content. Kind of walk us through how you're seeing this bidding war that does not look like it's going to end anytime soon, but it's probably pretty good for you.
Yeah, I mean, it's been unbelievable. It's a soap opera that's kind of fit for its own miniseries. I'm sure you've heard a lot about it on, you know, on the set of CNBC, but it started back in October. Warner Brothers was going to split up. Some shareholders kind of whispered in executives' ears, well, maybe you should sell the company if you're going to split it up. So they signaled that they would be open to a sale. Netflix approached them. They then ran a process. I think Comcast, Paramount, and Netflix all made bids. Netflix was the best bid at the time. And as usually happens when, you know, the losing bidders are very sad and they think, well, maybe we should have bid more. But instead, Paramount said, we actually will bid more. We're going to make a hostile bid after Warner Brothers decided to sell themselves to Netflix. And I think the opening that Netflix left them was that they made a bid that was part cash, part stock. People didn't necessarily want Netflix stock. And then there was also going to be a spun-off sub, the Discovery business. And so when you add all of these three things together, it's arguable what the value was. So Paramount saw an opening. They then made a hostile bid for $30, coming over the top, or what they thought was over the top. But the board has already considered the bid from Netflix to be superior from what was available at the time. Well, Paramount made the mistake of not having their debt guaranteed and not having the cash that they were willing to pay for it guaranteed, because David Ellison's father, Larry, is one of the richest people in the world. He was providing the financing for it, but he wasn't personally liable. He wasn't backstopping the financing. So the board said, no, that's, you know, sorry, it's still an inferior bid. Then he finally said, all right, I'll backstop the financing. It's $30. Netflix then came in and said, well, I'll tell you what, we're going to substitute the cash. We're going to be all stock, 27 and a quarter, but you're going to also get a stub called the Discovery business. And again, there was a little bit of a gap in a little bit of a hole in the argument that it was worth more, because it depends how you value Discovery to determine what the entire bid is worth. Meanwhile, the bidding, which started at $87, went to $87 billion, went over $90 billion. The current bidding is over $100 billion, which is unheard of. It makes it the biggest deal in the business today. There are some regulatory issues also. Also, Trump is going to weigh in on who's going to own CNN, what kind of coverage he's going to get. And because they do need FCC approval, because it's broadcasting business, there may be a political element to this. Meanwhile, this is all continuing. Both parties probably still have a little bit of room in their pocket to dig a little bit deeper. There's ways that Netflix can tweak the Discovery stub, maybe put less debt on it so that it's worth more when you add it to the 27 and a quarter. Paramount could have some more money in their pocket. You could see this bidding go up to 32, maybe $33. But as they say, the end is not in sight yet. It's very, very interesting, and it's provided some great opportunities for investors who are not ARBs as well as ARBs.
I'm enjoying how passionate you are about it. It's awesome.
Oh, it's great. It's so interesting.
Yeah, and I would imagine you're hoping this soap opera has many, many seasons to it.
We're hanging in there.
All right, good. John, I want to come back to you, just talk a little bit about the year-to-date outperformance on small caps. Before I actually ask that question, I just want to remind everyone, I think I misspoke. It's the Q&A tab for the webinar where you could ask a question that I will read to the panelists. I think I said it was in the chat. Please go to Q&A. I know all of these gentlemen really enjoy answering your questions, so I'd love to see some questions coming in. John, thank you for your patience on that.
Sure.
So the year-to-date outperformance on small caps, it's been explained to me, it's a variety of different reasons. It's the belief that maybe the economy is gaining momentum. It's certainly a mean reversion trade. But really what's unfolding is that you're not really seeing that mean reversion as it relates to high versus low quality. So I'm still seeing in 2026 some of the junkier elements or junkier parts of the equity market are staying kind of strong.
Yep.
How should we think about that, and what should we be looking for from the vital signs of the market itself to tell us,
Mhm.
okay,
Mhm.
here's
Yeah.
the environment where that high quality mean reversion is going to unfold?
Yeah, Joe, it's a great question. And I think, um, I feel like we could pull up the chart showing kind of the non-earners and earners and how they did last year, and that really tells part of the story. And I'm almost tempted after a big discussion about Warner Brothers here. I feel like talking about this in terms of a movie, right? And when you have a movie, you've got the build up, and what happens is you've got the low point, right? And then from the low point, you kind of build up to hopefully the recovery and the climax of the movie. And I think that's when you think about high quality versus low quality, I kind of think about that a little bit. I look at this and I see the huge excess returns that you've had, not since pretty much the internet bubble. I know there's a lot of comparison between this time frame and the internet bubble, but I don't want to get too much into that. I'm just looking at more into the extremes that we're seeing right now. And really this has been the story, right, for a while now. And I think where we see things is in this movies never really change overnight, right? So what has to happen is, as I said earlier, this reversion, it takes time. And to Michael's point, not everyone, this doesn't have to be a binary event, right? I think over time, the good businesses, okay, that are growing consistently, have good revenue growth, good margin improvement, et cetera, those are the ones, and they're trading at reasonable valuations. Those are the ones I think will get some of the love once that reversion starts happening. I think you are starting to see that. On the other hand, when you've got going back to, there's one chart we have in regards to the non-earners, which did fantastic from Liberation Day to the end of the year, up 47% versus 28% for the earners. There's another one where you're affording these high multiples to companies that don't even have earnings, right? I think those are the ones, in my opinion, where the more lower quality ones, where the steam kind of comes out of those a little bit quicker. There's that chart there. That's where I think you start seeing that. But in the end, you've got to still have strong businesses out there that are growing consistently to attract that capital from those other companies that have had high valuation. So for us, again, this doesn't happen overnight. Earnings are the proof theorem, right? So when earnings come out, and we're going to start seeing that happen, as you pointed out, we're just going to get going here this quarter for the end of year earnings, and we'll start seeing that. And hopefully, when you see that strength, that's when you start seeing that momentum build within those stocks, and that's where we think we have some good outperformance.
Yeah, the market is really going to want to understand what the earnings growth looks like from a lot of the equity names that have really been over the last several years, the drivers, the anchor. And that's where the concentration, though, kind of rooted itself.
Right.
Michael, early on in 26, we're seeing some of that concentration slightly come out of the market. We're seeing equal weighted strategies that are outperforming. I mentioned volatility before. I think of volatility, and I always have, two ways. To me, there's exit volatility, where investors are just looking to basically move away from ownership of a particular asset or strategy or style. And then there's reallocation volatility, where investors are just recognizing maybe an overvaluation or a risk in the market and moving capital from one area to the other. How do you see the concentration right now? Do you see it as a significant risk overall for the market? Do you see it more from the standpoint of we just need mean reversion in the overvaluation? How do we as investors think about that? And do you think what we're seeing for equal weighted early on has some sustainability to it?
Yeah, I think the equal weighted trade is very interesting here because it takes away some of that dramatic extra exposure that we've seen for the last few years that has been very profitable. And by company, you have to kind of dig in a little bit to say why. But it's interesting because the reallocation trade to help the small caps and the mid caps, which makes some sense. And again, we think that breadth is very healthy. It will only be continued if they beat earnings expectations, right? That's the, to John's point, these are the good companies that are growing, that are taking market share, that are putting up better financials than are currently priced in. So if the stocks are inexpensive, which in many cases those are, yes, all they need to do is just beat by a little, and those stocks will be strong. But if they don't, and not in John's portfolios, but the rest of the space, you'll run into the same problems you saw, I think, for the last 3 years. The concentration risk in the index isn't going anywhere, so it is something investors have to think about, right? You have to really be willing to consider the fact that even if you go passive in large cap growth, you're buying full boat index weights, and those are big. I think you need to be very cognizant, stock by stock, company by company, what the expectations are, what you're paying for that. And in the places where it's been a little bit softer, particularly in some stocks we don't own, like a Tesla, but in stocks that we have owned, like an Amazon or a Meta, where the margins are being reduced because of CapEx, versus places where the margins aren't. And you're seeing higher valuations in the places suddenly where the margins are being eroded a little bit because of investments in the business. We think those investments in the businesses are broadly wise, but the market may decide to not give you quite the multiple going forward. It's interesting to me, the companies that's growing the fastest, like an NVIDIA, is the cheapest of the group, or darn close to it. So it's stock specific. You've got to manage those positions. I think investors should be considering being overweight some and underweight others. And I think as the years go by, as we've seen already, I know in 2023, you could throw a stone at any one of these companies and make a bunch of money. That will get harder and harder to do as the group as a whole. Some stocks will do better than others. And the capital will go into those small and mid cap names, particularly if they start to beat. But they have to start to beat. They have to beat expectations. They've got to show real revenue and earnings growth. It won't just be a reversion to the mean, and then we'll let them kind of skate by. They've got to show they're growing too. I'm hopeful that they can, because I think that'll be good for breadth.
Yeah, Dave, listening to Mike, it reminds me of the usage of debt in this growth story. And again, I want to first apologize and secondarily thank you for the very fast phone call from the set of CNBC I gave you at 11:57 today, 3 minutes before the show, to ask you what was going on with Oracle, and were you seeing anything as it relates to the bonds. It's interesting. I pulled it up as we're doing this webinar. Really, the market bounced, and here's Oracle still, down at 173.85 on the day. So just kind of walk us a little bit through what's going on with Oracle, and then take those comments, if you would, and just kind of define the environment overall for the high yield market. Maybe is this a good time to use it as an equity replacement? How should we be thinking about a high yield market that performed pretty well last year?
Yeah, well, I would say first of all, if you look at the tech space, Oracle is a triple B investment grade credit. So it's investment grade. They do need to do a lot of financing, so there is the possibility that it could be downgraded, but I think they're a long way away from that. However, as I told you when you called me today, their 10-year is trading at 165 with a yield of about 6%, so it's already trading like high yield.
Right.
When these people are doing, they're investment grade companies with good cash flow, but they're doing equity-like financing with debt instruments, it's something you have to worry about. At the end of last year, in the last quarter, about 2% of the financing was done by the tech companies. After we had, was it Amazon, Meta, Oracle, Google, Netflix all come to market, it jumped to 10%. Now, looking forward this year, they need about 400 million of financing, which could be very, very painful, and you could see spreads widen out in the investment grade side. So it's something we're looking at very, very closely. Definitely have to be cognizant of it. As far as the high yield market, highest credit quality ever, Joe. We had $284 billion of downgrades. They're not defaulting, but companies like Ford, Occidental, Kraft Heinz, Hildebrand, Nordstrom's, to mention a few. Positive flows. We had a little over 20 billion, about 20.6 billion in 25. So money was chasing the asset class. Good earnings, lower leverage, maturity wall that had been pushed out, and then defaults all the way down to 188 from a long-term average of about 3.7. So the market, looked very attractive. Exposure that we had was market-like. Spreads are on the tighter side at 261, but I did mention, credit quality has improved pretty dramatically. And a yield right now of about 670. So I would say decent value in the high yield market. So more index-like, in all these sectors, because spreads are tight, Joe, we want to be dip buyers. Any type of trade-off, we're going to be looking to reload. We've got plenty of liquidity in the portfolios. As we know, over the last 24 months, any type of sell-off has been very short-lived. If we went to the European elections with the snap election in France, it was a 5-week dislocation, 5 weeks. We went to the yen carry trade, it was a 5-week dislocation. And Liberation Day was only a 10-week dislocation. Usually in high yield, I'm like, when spreads get to 650 and more, I'm a buyer. Over those 3 dislocations, spreads never got wider than 450. So we got to get in. We had to be tactical, had to be very aggressive, got into the market and got our exposure. And that's what you have to do. You have to be very, very quick because there's a lot of money on the sideline still.
Excellent. Thank you. Roy, we talked before about setting some expectations for returns as it relates to merger arbitrage. In the current environment, what are we thinking as far as returns? And then if in fact at some point in 26, the elevated volatility that I expect were to lead to a equity market correction, how are we thinking about returns there as well?
So maybe I'll answer your second question first. We fall into a category called absolute return strategies. The risks that we incur when we make our investments are the risks that the deals that we invest in will or will not be successfully completed. So we're taking on the closing risk of a deal. If we buy a target company stock at $9 and they're being acquired for $10 per share, as long as that transaction is completed, we will make that dollar regardless of whether the market goes up or down or sideways, and regardless of whether the acquiring company stock goes up or down or sideways. So you can see why it's a market neutral or an absolute return kind of a strategy. The additional volatility may create some opportunities for us as people need to sell their investments and maybe use it for other purposes, or maybe people want to try to pick a bottom and they sell the names that have absolute return potential, but not 20% AI type of potential. So sometimes we see supply during periods of extreme volatility. As far as returns, our returns are composed of what you can get in a risk-free investment, plus we are taking on the closing risk of a transaction. So we are compensated for taking on that closing risk of a transaction. And we're also providing liquidity to people who all of a sudden have a windfall when a stock they own is acquired, and they say, I'm not going to stick around for the last 50 cents or $1 or whatever. So we're liquidity providers. We take on the closing risk, and those functions we get compensated for on top of what you can get in a risk-free investment such as a treasury. If rates go down, our expected overall rates of return should go down. In this particular environment, though, it's being made up for by the massive quantity of deals that have been announced. I mean, everybody and their mother wants to do a merger. There's private deals, there's public deals. And so I would probably guide our expectation towards the high single digits type of range, depending upon if deal activity continues, if rates kind of, if, you know, I'm going to take Dave's advice and assume that there's going to be one or two rate cuts over the course of the year. I think that arbitrage spread should trade in that range, and provide that we pick the winners instead of the broken deals, we should be able to put up those same kind of numbers that we put up last year, which is roughly 9% or so.
Excellent. Thank you.
No guarantee of future performance, of course.
Of course. John, AI and the incorporation of AI, when you look at the companies within the portfolio, are we seeing the incorporation of AI, which obviously leads to the ability to elevate earnings growth? How should we think about and what the expectation should be for AI to be a contributing factor to the earnings growth?
Yeah, Joe, obviously, we hear a lot about AI in terms of the hyperscalers and the large caps, small and mid cap, again, you don't hear a lot about it, which, I view this actually as the opportunity, right? Because obviously the people spending the most on the AI will be the initial beneficiaries of it. So I think that's fair. I think over time is where we get excited is, the AI technology is just so differentiated in that, we've never really had a technology or an innovation where it can enhance revenue and take out costs. It does both, right? And especially when you've got a lot of low-hanging fruit in a lot of our types of businesses. I mean, one of our businesses is Rollins, which does Orkin pest control. And for crying out loud, they talk about using AI. So if they can utilize AI, then I think the fruit's pretty low on that. So where we get excited is when it does get incorporated, and I will tell you, maybe 25% of our companies even mention AI on their calls. But when it does, we think that the impact on that to revenue will be nice. And obviously on cost, so we see revenue improvement, we see margin improvement. So it kind of gives us even more confidence going forward that these businesses will take advantage of it. So for us, I'll use my baseball analogy, we're not even up to bat yet in a lot of these companies. So I get excited about that, frankly, and it's going to happen. If it can happen to Rollins, it can happen to anybody, pretty much. So we get excited about it, and we think we'll see some nice innovation in the future.
All right, let's answer a question from one of the attendees, and thank you for sending this question in, and I invite others to send in questions as well. Dave, talk a little bit about how you are thinking about an acceleration. Let me just move the question over. An acceleration with GDP growth and subsequent to that, inflation, pushing the 10-year towards 5%. If it moves in that direction on too good of an economy, is there a particular rate for the 10-year where you get concerned that weakness in the bond market will spill over into other risk assets, in particular the S&P 500, which is trading at an elevated valuation?
Yeah, sorry, Joe. Yeah, I mean, obviously it's always a concern is rates rise. Will the Fed continue to cut rates when GDP is rising, the economy is doing well? We've seen, bouts of that, right? With the data that we've seen very recently. We came into last year where all the strategists assured us that the 10-year Treasury was going to be at 5%. Came to the year at 460, it got to 480. Lo and behold, we had Liberation Day and it got down to 398. So rates move, we're much better at sector selection. That's 2/3 of our attribution for the last 30 years, top down, issue selection, bottom up, and staying in a tight range of rates, and really maybe implicitly in picking sectors, we're doing rate bets. But there's always the risk with $37 trillion deficit, being 130% debt to GDP, that rates could go up, the curve could steepen. Right now, 2s to 10s are 70 basis points. So we've seen rates back up. We saw what happened in Japan. They're the outlier in the developed markets with 248% debt to GDP. And then they announced they're going to cut food costs with no offset in their deficit. And we've seen rates back up. Their 40-year JGB got well over 4%. It used to all be owned, for 30 years, their rates were under 50 basis points, was all owned domestically. And now 65% are held outside of Japan. So definitely a consideration, Joe. Could rates back up? Start getting concerned if the 10-year gets above 5%. But right now we sit at, I believe we're at 428. We have a long way to go to get there. But the fiscal deficit is definitely a concern, right? We have four things we can do. We can default on, our debt, which we're not going to do. We can pay it off, which we can't afford. We can grow at 8% nominally, which ain't in the cards, or we continue to kick the can down the road and print money. Until something actually happens, no politician's going to sit back and tell you how they're going to reduce the deficit because they want to get reelected. So I just say in the interim, we continue to print money, kick the can down the road, Joe.
Well, right now we're trying to grow at 8%. That's
Wish we could.
Michael,
Yes,
a
sir.
question as it relates to mega cap stocks and their ability to continue to represent the type of growth, the astronomical growth over the last several years.
Yeah. Some yes, some no, right? It's not a uniform behavior. And it was in the beginning, right? Everything, like I said earlier, you could just invest in and hold tight. But we think it gets harder over time. Expectations, the longer these companies continue to beat numbers, right, then the beat is expected. I would argue that NVIDIA beating $2 billion every quarter is no longer beating expectations. It's actually kind of expectations. So there'll be spots where they need to do better, and that's what all this CapEx has been for, right? And that's what the expectation around the hyperscalers is. And we think by and large there's winners and losers in there, but the losers are still winning. So to John's point earlier, we're waiting for this use case for small cap, for mid cap. And we're waiting for more and more opportunities to say, this is where the ROI really is, because the ROI right now is in these companies, is in these first movers. But it can't stay there. It has to spread. And as it spreads, whoever supports them the best, provides them the most, will continue to see more demand, and then the growth will continue. This is not, we've talked about this, and it's always risk at hyperbole, but this is not just a regular tech cycle. We think it's quite a bit larger. To John's point earlier, it is both revenue and cost cutting, and that's a great place to be. So we know that the winners should continue to win. There will be increased competition, right? So it's not quite as easy as saying, hey, you buy all the mega caps, you don't buy all the mega caps. I think you've got to be very specific about your weights. I think you have to be very specific about what the weight is in the index. If your goal is to beat the benchmark, which is our goal, then we have to pick those stocks a little more sharply. That's been easier to do in 2023 than it will be in 2026. And that's fine. That's fine. That's exactly what you're hiring money managers to do. They should be able to do that, navigate those places. But by and large, they are still growing the fastest. By and large, they are still generating the great majority of the index's free cash flow. That continues in the short term and probably in the intermediate term. And in the longer term, John nailed it. We have to see that. It's very exciting to see what kind of innovations it will bring. We have just scratched the surface.
Okay. All right, everyone, I want to be very respectful of your time, but please be patient here. Just afford us another minute or two, if you would. First of all, Dave, Roy, John, and Michael, I want to thank you so much for your thoughtful observations and expectations. You always educate me, and I really enjoy working with you on these quarterly calls. I look forward to the next one, which we will have in April, and certainly the market will evolve from there. To all of you who have taken time, as I said before, out of your busy schedule to join, I want to wish you health and happiness for you and your family and 26, life's two greatest assets. And stay with us here another minute or so. I now want to turn the call over to Barry, and he's going to wrap the call up with some remarks.
Okay, thanks, Joe. And thanks, everybody, for attending today's call. If you want to get any additional insights or commentary, please visit us at Virtus.com. If you have any specific questions you'd like further information on, please give us a call at 1-800-243-4361. I, too, want to thank Joe, Dave, Roy, John, and Michael. Great conversation here today, and I hope everybody found it very productive. Thanks, everybody, and have a great evening.